What's going on, guys? Thank you for tuning into this episode of Twin Finance. My name is Dylan, and today we're going to be talking a little bit about segregated funds. And that's what I've written down here. And what a segregated fund is, guys, is it's offered through an insurance company. So an insurance company, you're going to buy it through them. And the three things that are pretty big about segregated funds that you're going to want to know is there's going to be a guarantee of some sort. And these two guarantees are maturity and death benefit. So I just wrote M for maturity, DB for death benefit. And these can range from 50% to 100% for the maturity. And death benefit's usually going to be 100% guaranteed, guys. And what that means is maturity guarantee means usually you're locked into a contract. So I'm going to write this about this. Another big thing about segregated funds is you're locked in for 10 years. Locked in 10 years, usually. 10 years plus. So the minimum contract is usually going to be 10 years. So that's what you're going to be locked in for. But that doesn't mean that you can't sell it. It just means if you do sell your segregated funds or, transfer to a new one, they're going to usually impose some fees on that. So if you want to sell no fees, you're going to be usually locked in for 10 years. And basically what this 10-year maturity date has to do with it is the maturity guarantee is 50 to 100%. So let's say it was 100% guaranteed. Let's say you invested $1 million. It only guarantees you the 100% of your initial investment. So that $1 million you'd be guaranteed at the end of the 10 years. Let's say it was 50%. You'd only be guaranteed $500,000. So at the end of the 10 years, you're only guaranteed $500,000. If it's less than that, they're still going to give you $500,000. But if it's more than that, you're going to get that market value of it. So this is what I want to talk about. These two real quick is another thing about usually the maturity guarantee is if it's a 50% guarantee, it's usually in a more risky investment. Maybe a fund like an equity growth fund or let's say a stock or whatnot. It's going to be a higher risk investment. 100% guarantee, as you move up closer to the 100% guarantee, it's going to be like a GIC, guys, a government bond and whatnot. Because if they're going to guarantee you 100% of their money, 100% of your money, well, they're not going to go out and then lose a bunch of money and then they're going to have to pay you double, right? So that's not what their game plan is. So if you want a 100% maturity guarantee, don't expect higher returns. If you want 50%, it gives you that room for more growth. Death benefit guarantee essentially is what it sounds like, guys. So let's say you're locked in for 10 years and the policyholder of that contract dies. Well, 100% guaranteed of the money. So if you had $1 million, the $1 million would go to his estate or the beneficiary of the contract. So that's all that means, guys. The two things. So that's basically the two things you're going to want to know about them. I'm going to run through some ways that they can be beneficial to you. So I'd say the number one thing is this relates to like the death benefit would be when you let's say you had a contract, and you died during that contract, so 100% of the death benefit, of your initial investment is guaranteed through the death benefit guarantee. So that let's say it was $1 million. Well, that $1 million is going to bypass probate when you die. Bypass probate because it's locked in, it's creditor protected. Probate. Bypass probate. So that means it's not going to be subject to any state or provincial taxes when you die. So it's going to go to your family or whoever the beneficiary may be, 100% tax free, which is good. You don't want to die and your money gets massively taxed and sent to your family way less, right? So, and another thing about segregated funds is creditor protected. Creditor protected. And what that means is, I'm sure if you're a business owner, you probably know more about this, but let's say you owned a company and it was a sole proprietorship, so you were the single business owner, and your business got sued $1 million, and your business was only worth, $400,000. Well, they can't just go into your segregated fund and take $600,000 of it, right? It's creditor protected. So let's say you get sued, that's untouchable money. No one can take that from you. That's another thing that's good about segregated funds, especially if you're a business owner. Another thing that's also good about it is obviously the guarantee. The guarantee is obviously appealing to a lot of investors because, a lot of investors don't like to take massive risks, and they want to know, like, they have a peace of mind now, you know, like my money might not be too low, or I'm guaranteed not to lose money if, you know, if I chose that 100% guarantee. So that's really it for segregated funds, guys. The two things I want to just let you know before the video is done is, if you're a new investor, let's say you're younger, you're in your 20s or even younger than that, even in your 30s, guys, and you're looking for growth, segregated funds probably aren't the best way to do it. I mean, you can obviously get growth with segregated funds and guarantee at the same time, but probably not the best way if you're looking for pure growth. But if you're older in your days, you know, you're looking forward to retirement, or you are already retired, and you're looking to leave a good amount to your family, definitely a good choice. Like I said, with the probate, bypasses it. It's definitely a good choice for your family. It's also good for security and whatnot, guys. So I hope you enjoyed this video. Remember to subscribe to the channel. And also, if you want to know more about investing, be sure to watch the videos on the channel. I hope you enjoyed this video, and take care, guys. Have a great day.